Hello everyone. In last video, we explained the cost flow from the different inventory account in the balance sheet and finally captured by the cost of goods sold in the income statement. Among them, direct material, and direct labor can be directly added to the work in process for different jobs or different departments due to their direct nature related to the production. But the manufacture overhead as the indirect manufacture cost, they incurred to support all of the production of different jobs or different products under the department. So by this nature, we couldn't debit or add the overhead when they incurred to the different jobs. So in practice, in the accounting system, we open the manufacturer overhead account as they call a clearance account. So for this account, when the different overhead incurred over the time in the reporting period, such as your indirect labors, indirect materials, and the depreciation of machineries, and other related overhead costs, when they incurred over time, we debited to the left side of the overhead account with related credit. Okay, you can use credit as raw material, wage payables, or accumulated depreciations on the credit side. So you can check in the book, they have detailed of the journal entries. For the Excel, I focus on the debit, okay, which are all of the amount we debited to the actual side of the overhead account. In our example, we have 5 different actual overhead items added through the reporting period. And then when we apply the overhead, normally the application of overhead is a one-time issue when the job is completed. So in our case, we applied the 19,000 overhead to the 2 different jobs. We have job A and job B in the reporting period. So job A got 60,000 applied overhead and job B got 30,000 because of the actual direct labor hours they used. So the actual allocation base. So as a result, in the end of the reporting period, the actual overhead and applied overhead won't be the same, right? Because the predetermined overhead is estimated. So in the end of the accounting period, you can compare the total actual overhead incurred with the total applied overhead. We found a balance we call under-applied or over-applied overhead, depending on the actual number is larger or smaller than applied amount. So there will be 2 situations possible. In our case, the total actual overhead is 95,000, which is larger than the applied 90,000. So if the actual larger than the applied, we call under applied overhead. So means we didn't apply enough. So you didn't apply adequately for the actual overhead. So under applied by 5,000. Or if the other case, if the applied overhead, so at the parentheses, in one reporting period, you only can have one situation. It wouldn't be both. In our case, is underapplied. Sometimes it can be the applied overhead larger than the actual overhead. Then we overapplied. You overapplied overhead than the actual numbers. So if the we have under or overapplied applied overhead, the balance we wouldn't let it stay in the overhead account. We will clear the manufacturer overhead. So means you have to remove this under or over applied balance to different places. One easy approach is to add or basically move this balance amount to the cost of goods sold. Because as we can see, eventually the cost flow is captured by the cost of goods sold account. Theoretically, the under or over applied overhead will be impacting the working in process account because this is the first place we add the applied overhead, then flow to the finished goods, and finally to the cost of goods sold. Theoretically, all of the three accounts, working in process, finished goods, and cost of goods sold, are all impacted by the over or under applied overhead. So this is the best approach if you can split this 5,000 among the three accounts, maybe by their balances. But this is sometimes there is too much work, and if the overhead balance is not really large, like a small balance, we can take a easy approach, like a shortcut. So we can add or deduct the balance directly under the cost of goods sold. So directly to the cost of goods sold and omit the working process and finish the goods. And this is the approach we used in this example. So for the 5,000 under applied, because before we clear it, we have a debit balance. So we remove this balance from the credit side. In accounting, if we have debit, we have to decrease this balance by using a credit. So we credit the manufacturer overhead 5,000 and debit the cost of goods sold. So this is adjustment of the overhead balance. In that case, the cost of goods sold will be added. Initially, we have 18,500. So the 5,000 will be added to the original cost of goods sold, and we got the adjusted cost of goods sold. So 123,500. That's for under applied overhead. If you, in other case, you have over applied overhead, then we adjust the cost of goods sold on the opposite side, credit. We credit the cost of goods sold and debit a manufacturer overhead. And this debit is not a new overhead, is helping balance the overhead account. Okay, that's for the over applied case. So after you deal with, so moving out, clear out the balance, the manufacturer overhead will have zero balance. So that's I put a double line. So that means cleared out. So it's a clearing account. We close this manufacturer overhead for this reporting period, and then for next month or next period, we start this process again. Okay. So each period, they wouldn't affect each other. So, and eventually this balance added or deducted reflected in your cost of goods sold account. So that's the way we handle the manufacturer overhead because of the actual and applied the varied amount. So now let's take a look for the income statement. Okay, we explained a little bit yesterday. So in the income statement, we can find out the sales revenue by using the sales price multiplied by the units sold. So the original sales revenue, we debit the accounts receivable and credit the sales revenue. I put this debit is for closing. Okay, after eventually the closing process, these are temporary account. We learned the temporary account and permanent account in 231. All of the accounts under income statement are temporary account. It will be closed to the returned earnings. So initially the sales revenue is credited by 225,000 for this question. And then cost of goods sold, the adjusted is on the debit of 123. And all of the period expenses. selling, admin, and general expenses, they are non-manufacturer cost. Non-manufacturer cost doesn't go through the cost flow, the inventory account. So they directly deducted. So will be recorded first and then deducted in the income statement. Again, if you check the detailed transaction in the book, we have I believe this 30,000 is wage and salaries for the period, like selling department, admin department, their staff, salary, and payrolls. 7,000 is depreciation for the office buildings or office equipment. 42,000 is advertisement and promotional expense. And 8,000, I forgot about additional admin expenses. So when the period expense happens, they directly captured by the related expense account and closed to the return earnings and deducted in the income statement. So the final income statement will look like. So the income statement reflects the account information we just talked about. Okay, so the sales revenue, then minus the cost of goods sold. This is the absorption traditional income statement, not the contribution margin. So we have a gross margin 101,500. Okay, so gross margin is the important middle item we show in the traditional financial accounting income statement. Before that, we deduct the cost of goods sold, which is manufacturer cost. And after that, we deduct all of the period expenses, 87,000. So net operating income before adding or deducting any other items is 14,500. Okay, so income statement. And I will stop here. In the next video, I will explain the cost of goods manufactured and the cost of goods sold report.